My name is Josh Rosenthal. I'm a general partner and portfolio manager at Polychain Capital. Thanks everyone for joining today. We've got a great topic to discuss here, and I'll kick it off with a headline that was in Bloomberg in August, which was Treasuries go 24/7 as repo trade hits blockchain on a Saturday. Now, I was in front of my LPs last week talking about how this was the most meaningful transaction that happened on a public blockchain last year. There were a number of parties who were around the table at that transaction: Virtu, DRW, Circle, TradeWeb, SocGen, but then also these two guys who were key to making this possible. So on stage with me today, we've got Yuval Rooz, the co-founder and CEO of Digital Asset, which is the creator of the Canton network, and then Mike Winnike, who's a managing director at the DTCC. So we're going to dive into that transaction that was referenced in the Bloomberg article, and then many more implications when it comes to tokenization and bringing institutions on chain. So maybe just to get things started, it'd be great, Yuval first, and then Mike, to give quick backgrounds on, first of all, who you are, and then what you're working on, and we can jump into content from there.
Sure. Thank you, Josh. I'm Yuval. I'm the co-founder and CEO of Digital Asset. We are the company that created Canton Network, which is the first public chain with privacy-preserving capabilities. It happened this year, maybe on the last Jewish calendar year, but it was actually just 4 months ago. But it feels like a long time ago. There's a lot that has happened. But I think if you kind of take into consideration some of the comments that I heard Rob say on the previous panel, I think that everybody's extremely excited about tokenization, and you hear a lot of people saying, we tokenize something, and now, I don't know, Tesla has X amount of new investors, and that's not factually correct. The reason is that, for the most part, most of these transactions are really just buying assets in a Web 2 style, and then they just mint IOU tokens, meaning you have some kind of a claim on chain against some broker-dealer, which is usually in the BVIs. Not really something that institutions would participate at scale in. And therefore, what we're trying to do is we're trying to actually get the books and records to be natively on chain. So when you're holding a token, you're holding legal tender. You're actually holding the asset. And we believe that only this way we're going to get the institutional flow to come into, participating on chain. So that transaction was together with DTCC, and Mike can talk more about DTCC. But for those that don't know DTCC, it's the largest CSD in the world, manages, I think, about $80 trillion worth of assets, and pretty much every major financial institution has an account there. And what we wanted to show is that you could actually hold not tokenized treasuries, but actual treasuries at the DTCC, just holding them on chain. So we're not actually changing the way that the market is managed, we're just making it more efficient. And the example that you mentioned, it's a lot of TradFi, but also crypto-native organizations like Virtu and Cumberland, which are both. And now, for the first time, they can actually go into the after-hours long treasuries. They don't give up the yield by holding stable coins. And any given point of time, they can actually just convert their U.S. treasuries into stable coins if there's activity in crypto. But you don't need to require a lot of imagination to think that, well, if it works for crypto, it also works for traditional markets. And for me, as Josh said, it is the only opening shot for a lot of very exciting things to come. So maybe I'll let Mike continue that.
Great. Well, it's a pleasure to be here. Michael Winnike. I run the strategy and market solutions team at DTCC. And among the roles that we play, we are looking at the opportunities to unlock new value for markets and market participants as we integrate new DLT technology into our core infrastructure. And as you mentioned, DTCC, our mission is really to create the foundations that allow capital markets to grow and flourish. And the way we generally do that today is through our services and infrastructure, right, that create capital efficiency, legal certainty, large-scale network effects, and wrapping this all in operational and legal resiliency. So when we're thinking about the opportunities for 27 mobility of assets and how that could impact the financing markets, it definitely appeals to our mission, right, in terms of how we allow our members to get more efficiency, capital efficiency, right, out of the assets that they hold. In terms of the test trade that occurred, we were kind of observers. We played a role. I do want to make clear we didn't actually tokenize an asset. That's obviously something that would involve a lot of engagement with our regulators, et cetera. But we are very interested in the opportunities to invest in this market structure change, and we certainly have discussed publicly our ambitions to be able to make available to the market the assets, the 100 trillion or so in assets that are held at our depository, on chain for use cases like the one that we saw. Now, in terms of I guess our thinking beyond just the P&L kind of benefits, I think there was the question of, well, what is the foundation, right, that can enable 24/7 finance? What are the preconditions for that? And when we think about that, yes, it's exactly what you've all mentioned, right? You need the legal certainty that the asset that's represented on chain is the exact same asset that you could have in traditional book entry form. But it goes beyond that, right? If you're in a financing trade, what do you need to know, right? You need to know that the asset that you're holding is one that in the sad case, where your counterparty is insolvent, and these things tend to be highly correlated. So maybe not just your counterparty, but a broker that might be intermediating in some capacity is insolvent, or an issuer. There's other insolvencies in the ecosystem. Do you have the right UCC treatment, right? That you know that you not only are holding the real asset, but that it will be your asset, right, in the event of insolvencies. And when we look at other tokenization models out there, there's really questions around, are you taking new creditor risk? Is this more of an IOU rather than your asset? So I think that's one foundational aspect for traditional finance, but also for moving assets on chain that has to be delivered. So there's the legal certainty aspect there. Then you have to be able to sell the asset. So the method of this asset that you're holding, being reflected on potentially, a ledger like Canton, do you have access to pools of liquidity, right? And is there interoperability? So when we think about that, that means not only being able to represent assets on chain, but the high fidelity back to the deepest pools of liquidity. So maybe that means you can liquidate on chain if there's trading applications stood up in liquidity, but you can also rapidly move that asset back to traditional form if you want to take advantage of liquidity in the traditional markets. So having collateral is only good as your ability to liquidate, right? And then finally, this all needs to be wrapped in operational resilience, right? So are there clear rules, outcomes, right, if there is something that goes wrong from a technical perspective? And this was all sort of highlighted in the IOSCO paper, I think, if anyone read it, came out yesterday on tokenization, highlighting some of these risks around, hey, as assets move on chain, you're potentially getting into new territory and untested bankruptcy treatment. So how do we address that? You're potentially getting into fragmentation of liquidity, right? How is that addressed? And then you're introducing elements of operational risk that exist in parallel forms in traditional markets today, but how do you deal with issues around cybersecurity, et cetera? And what role can then DTC play in creating that sort of resilience and fallback for members? So if a key is lost, it doesn't mean that you no longer have access to your collateral, right? There's resolution pathways.
Great. I think many things to double click in both of what was said, and we're thrilled to have both of these guys up here. Yuval and Canton just launched a podcast called Quadrillions, and a big reason that's the title is because they're working with parties such as the DTCC who facilitate transactions that I think are measured in the trillions on a daily basis. So the size of the prize here is quite immense. So let's talk a little bit more about this repo transaction. So repos are probably about the most vanilla transaction that you could imagine. However, I think the specific transaction really helps kind of highlight why this differentiated approach to tokenization facilitates institutional adoption versus some of the other models that we've seen. I think the last panel said verbatim, X stocks is a scam. Great tagline for us. So Yuval, walk us through the steps of the transaction, and spend some time talking about why this model of tokenization actually is what kind of enables this to happen.
Sure. So you're right that repo is a pretty vanilla type of product, but it's a vanilla product that moves $10 trillion worth of value every single day. And it is kind of the backbone of how banks meet their capital requirements on a daily basis. So just in the US, the repo market is north of $5 trillion notional every single day. But the really good thing about a vanilla type of transaction is that within it, it has a lot of the critical building blocks that Mike, for example, alluded to. Really, for those of you that don't know what repo is and you want to speak crypto, it's staking US Treasuries. You stake US Treasuries in return for some USDC. In our case, it's US dollars at the Fed. And that's how you meet your capital obligations as a bank. And when you return your capital, the person unstakes your US Treasuries. That's really what it is. The problem is, because of the notional that we're talking about, you need to make sure that you have the legal certainty, as Mike talked about, first of all, that the collateral is perfected, meaning if the person doesn't return the cash, can you actually put your hands on the US Treasury? Can you actually liquidate those US Treasuries? Like, all of those things matter. So it is a very simple transaction, but within it, it has a lot of the building blocks. So that's why it was a really good place to start, is because, first of all, it's a super important mission-critical piece of capital markets. I think that if you actually can do repo in TradFi the way that you do staking in crypto, there's a massive unlock from capital efficiency perspective. There's quite a significant return to financial players. Broadridge, for example, is doing on-chain repo, and they're already getting close to 10% of the daily volume. And they are showing significant returns to the clients that are using it. And second of all, again, if you start thinking about it in crypto today, things are being done in a very inefficient manner. So I think that, again, what we're trying to do is we're trying to show that if you move TradFi to crypto rails, there's effectively quite a lot of efficiency that you can unlock. And that's why, for us, this one specific transaction was able to show benefits both to TradFi and to crypto. I mentioned in this case, it was really being able to repo US Treasuries, stake US Treasuries in return for USDC, and really, again, starting to test the pipes. How do you actually onboard TradFi players into this new world? So you mentioned there was Bank of America. We don't think of Bank of America necessarily as a crypto-native firm, but again, for the first time, having to install wallets, be able to connect to a chain. SocGen was as well. And then we had trading firms like Virtue and DRW, which owns Cumberland, are the actual counterparties doing the transaction. And what was even more impressive is that the company that built the staking product was Tradeweb, which is the largest fixed income and rates exchange in the world. And again, having those type of players that are already connected to all the players in TradFi actually start participating in a crypto-native fashion is very exciting.
And I think if you're the counterparty, delivering dollars or USDC in this circumstance and taking treasuries in receipt, you want the treasuries. You don't want to have an IOU for an SPV that's domiciled in the Bahamas that's run by a handful of random SPV managers. So that multiple jump path to kind of get to the underlying asset is not enough for institutions. I think it may be enough for your kind of typical retail user, but for broad-based adoption by regulated financial institutions, it's just unlikely.
If I can just, and before, so I think that what you said now is, and kind of back to the word quadrillions, we keep on reading all of these reports. Tokenization will bring trillions of dollars of assets on chain. And if we really want the players that have T's on their balance sheet to participate, whether it's the DTCC, whether it's Wellington, whether it's BlackRock, whether it's PIMCO, all of those named Capital Group, they're not going to put that much value at risk unless they know that all of the things that Mike talked about and were mentioned in addition are perfected. They're just not going to play in these markets. They're not going to put so much value at risk. I think we're going to see international investors that have no access to capital markets willing to take that risk, because again, for them, it's nothing versus taking some risk. But if we truly want all of these reports about tokenization to materialize, we have to do it the right way.
And so I want to spend some time on risk because I do think it's an underexplored area when it comes to tokenization. 24/7 markets are something that traditional markets are not used to. I've been in crypto for 4 years now, and I'm barely used to it. So, Mike, I'd love to hear kind of your perspectives about, the risks that 24/7 markets present. We hear often about, the risk that stablecoins may bring to the system with regards to like bank runs, for example. So what types of guardrails and controls do you think institutions need to see to fully adopt this technology? And maybe also spend some time talking about, is this kind of a blockchain level enforcement? Is this more of a kind of regulatory and governance approach? But would love to just kind of hear you explore some of the risks here.
Sure. So, I think in terms of guardrails, we covered the really important foundational elements around, operational resilience, the certainty that's required from a legal perspective. But there's multiple dimensions here when we think about risk. Are you thinking about from the perspective of the financing counterparty and like what your liquidity needs are, right? So if you're taking in a tokenized asset on a weekend, right, that could create a new opportunity. That's a new market, right, that's developing. So that's an opportunity for new P&L, which is, I think, one of the exciting things about that test trade is like if you want adoption, it can't all be, well, some utopian state, we all get there at once and all of a sudden we retire our legacy systems, we have operational efficiency. You need actual real use cases with real P&L that develop new markets and utility that, allow people to leg into this. And so I do want to just make sure we're kind of double clicking on that. But in terms of the risk of participating in those markets, right? So I think as a lender, right, you have to think about, well, what are your obligations, right, from a liquidity perspective if you have to seize and act on the collateral? Are you okay being able to hold that collateral that you've seized and potentially liquidate it in traditional markets when they kind of open on a Monday and the liquidity is deepest, and that your own liquidity obligations are such that they can be kind of postponed at that point? Or do you have to kind of leg in size that is related to 24/7 liquidity that could emerge for that actual asset over the weekend itself, right? So I think there's all sorts of commercial and market risk, right, that firms are going to think about as they start with financing over the weekend and then think about how that translates into underlying market activity. In terms of any asset being on chain, though, there's also the issues around just the operational risk and the understanding of how to manage those assets on chain. And I think that's in terms of adoption, as we see from a custody perspective, right, more brand names that are coming to the table with solutions for institutional investors that are required to have qualified custodians, right? I think that is an enabler, right, for broader participation, as well as firms and the SEC and others also thinking about what does self-custody look like, right? And is that a market structure that regulators in the market want to push forward? So I think there's a lot of kind of risk and guardrails around that are operational and things in the background that institutions like DTCC can provide. But there's other market or elements and things that other ecosystem players will have to get plugged into to help facilitate and scale.
Yeah, I think that all of the above. I think that one important thing that is going to be critical is that I think certain risks will decay over time, meaning new rails, is the technology tested, and just over time you will see certain parameters of the risk framework just decay, been running for X years, it's sufficiently tested. I think that there are other risks that will just exist long term. For example, we talked about, and Mike brought up a good point about the liquidity over the weekend. I think that as we start thinking about pledging collateral on chain, you will really have to be educated. What are the risks related to this collateral? It's not just are you actually getting the actual asset, but for example, one of the risks of, we saw in the crypto event when you had auto deleveraging, and those things could happen over the weekend, and now suddenly you get unwinded from a leveraged position over the weekend, but there's no liquidity. You could create some pretty significant price shocks. And again, that's just the reality of 24/7, and it's something that needs to be taken into consideration. So I do want to give a shout out. Charles from S&P is here, is actually just really thinking about how do we educate the market about those risk frameworks. And I think that that's one exciting opportunity in terms of how we think about rating. Today, rating would be more kind of like counterparty risk, like how do I rate a bond or some kind of a credit risk. I think that one of the things that S&P, for example, is really thinking about, which is a great thing, is, well, how do we think about those risks with respect to tokenization, which is infra, cyber, liquidity across, and we're just going to see this new type of development going forward that would have to be associated with tokenization, just because we're seeing how many different options are coming to the market. And it's not important just for the investors that are participating, but it's also going to be important for a clearinghouse that wants to accept collateral to think about how much of this collateral I'm willing to accept as a result of all of these risk parameters.
And maybe just to build on that, and I did bring up the liquidity risk issue, how you think about that on the weekends, but it's also a big opportunity, right, from a risk perspective, in the sense that market participants today extend loans that last over the weekend, and that's accounted for by haircuts and potentially, taking into account the price of that. And today there are firms that are, borrowing, right, on a Friday more maybe than they need, right, because they need some working capital. Maybe they're going to deploy over the weekend. So if you can move to the development of more real-time markets, and there is liquidity on the weekend, you might be able to shave off some portion of a haircut, right? So there's the ability that risk management as ecosystems can be developed and enhanced, and maybe the ability with the right haircuts and guardrails to still leg into this today as those ecosystems are developing.
Thank you for being positive, Mike.
This has been hit on a few times now, and I think Mike, you put it well. Companies aren't just going to participate in these pilots, et cetera, for marketing or Bloomberg headlines. There needs to be a real kind of P&L incentive here. And Yuval, I think digital assets been up close and personal with a lot of these institutions who are now finally starting to say, let's try this. And you guys have been at this for, I think, about 10 years at this point. So, why now? What has changed that's starting to bring these financial institutions into the playing field and, meaningfully participating in these pilot transactions?
So I think that, to be honest, it's not now. I mean, some of our partners have been at it for years and have been seeing the returns for years. I think that what have changed now is that the posture in the US is almost kind of, if you're not using this technology and leaning in, you're on the bad side of the fence. So I think what you're seeing is that people are becoming much more comfortable sharing in the public domain what they're doing. We didn't arrive to almost 10% of the repo market with Broadridge in the last few months. It's been worked on for a very, very long time. And what I think you're seeing now is that people are willing to move forward faster. And I think that at this point you're also just seeing enough examples that are showing that there is real value. I'll take something outside of Canton that I like to talk a lot about is, Figure went public recently and have shown that if you use this technology, you could shave close to 100 points off of a HELOC, which is a credit line against your home equity. That is massive. That's I mean, if you listen to Sequoia when they talk about play with your margins, I mean, if you can reduce a whole % off of a loan, that gives you a massive competitive advantage. So I think that what you're seeing is a combination of the administration in the US being much more open and is almost kind of telling people you have to lean in. So people are actually moving faster. I think that people that have been building quietly for the last few years are willing to be much more open about it. And then I think that you have just real proven results of what is the capability of the technology.
No, I think, my joke about, Canton and digital assets, it's a, overnight success that's been, 10 years in the making. And I think, a lot of the things that you mentioned just kind of speak to that. Oftentimes when, there's a new kind of technological paradigm that's being, brought forth, there's kind of an initial thrust that needs to happen where you're kind of, pushing concepts upon your, target customer. But I'd be curious, both, you, Yuval and Mike, where are you guys starting to see a pull from your customer base in terms of what they want to see on chain, whether it's a certain asset type or a transaction type?
Yeah, so I think that when we engage with our members in the market, right, there's different emerging use cases where we see different demand from different types of participants. I think one where we see near universal agreement is that collateral workflows, and repo is an element of a collateral workflow, right, can be really enhanced by being able to move assets on chain. And enhanced in what ways, right? Part of this is about just the 24/7 nature of mobility on chain. And when we think about markets, right, a lot of the cycles we have today are very much based on a business day. They're kind of assume New York hours, right? And that made sense in a much less globalized world where finance was not as potentially integrated into every part of the economy and even retail user kind of banking applications, finance, et cetera. And so the mere ability to put assets on chain and allow them to potentially move out of one account at DTCC to another account to fund activity that's starting on a Sunday morning in our time in Japan, right, is entirely new capital efficiency and just is essentially an enhancement of our existing services, right, if we're able to unlock that. But it's more than just the mobility, it's also then the programmability that you can put on top of that. So once we're able to put assets on rails, make them move faster and with heightened transparency, how can you use smart contracts to take away some of the back office pain? Right, that creates friction around those processes. So we hear a lot of enthusiasm around those, but I think when those use cases are tied to new markets and P&L, right, that allows them to start adoption and grow sort of the network effects that can lead to broader adoption. I do think there's also the distribution use cases that are emerging, which are from maybe more issuer-centric, right? So if you're a BlackRock or a Vanguard and you're thinking about getting your ETFs in the hands of a new generation of investors who are more crypto-first, crypto-native, like how do you create an experience that has that same look and feel that they're used to on crypto rails kind of merged into one consolidated platform? So maybe different levels and pace of adoption and maybe different participants, but another area of interest that people are thinking about.
Yeah, so I think that everything that Mike said around programmability and smart contracts, and just to put it in context, why I think that collateral is going to be probably one of the first that will get the scale is just because you don't need that many players in order to achieve that scale. About 15 to 20% of eligible collateral actually gets used, and I think that if we put it on chain, we're going to see much more collateral gets used, and therefore financial institutions will be able to be much more capital efficient. So the return on the investment could be very fast by not doing that much. And again, that's great for the technology because you will be able to show real returns. Of course, there's a lot of excitement about the equities market, mainly because again, it's a very retail kind of narrative right now. But to be honest, again, massive implications to large institutional players. I would say that the equity market, though, is much more complicated from a structure perspective, and rewiring it will take longer. One of the areas that we've been very focused on, though, is also private markets, which there's a lot of inefficiency that exists. And as you're looking at the growth of the private markets compared to public markets, I mean, they're growing significantly faster, and they want the ticket sizes to be smaller, and therefore you have to solve the operational inefficiency. And then I think that payments on chain is critical, and I'm saying that purposefully this way and not stable coins, because there's going to be many types of instruments to do on-chain payments. And that's really where I think that us focusing on privacy is key, because again, retail might be okay with no privacy. I think that institutional players have fiduciary duties, but also publicly traded companies don't necessarily want the whole world to see all of their on-chain activity, and therefore I think it would be a must-have feature in order to unlock on-chain payments at scale.
So we could spend another 30 minutes on privacy, but we'll spare everyone and maybe save it for next year. We have about a minute left, which is enough time for you guys to give formal price targets for year end. I kid. Just maybe a kind of just rapid fire question for both of you. What do you guys think is maybe the most underrated or misunderstood component about tokenization that you guys are particularly excited about?
So I think we've covered a lot of the excitement about tokenization, but I do think that what we're looking for is both to kind of enable the market and its innovation and kind of for that to take off with foundations, right, that we can help develop. But I think that we also have an element of needing to bring the market together, because even though there are some use cases where you can have limited network effects and still create value, there is a need to kind of not just hand people like an ice pick and the crampons and say there's value at the top of the mountain. Like, there are institutions that also need Sherpas and need forums for bringing people together to integrate all the things around like back office processes and OEMSs and kind of all that infrastructure that can kind of smooth the path for institutional adoption. And so it's, yes, the technology is important, but it's the ecosystem, partnership, education that's going to be, and frankly, clarity around legal frameworks, et cetera, that is going to matter, as much, if not more so, than just the underlying technology infrastructure.
For me, the exciting part about tokenization is that a lot of times people, when they talk about tokenization, they immediately bring up 24/7, even the name of this panel. Even when you look at crypto, there's not that much volume happening over the weekend. To me, the 24/7 is more having the optionality in case something happens after hours. I don't think that just because of tokenization, we're just going to start seeing a ton of activity over the weekend. So to me, actually, the more exciting part about tokenization is actually connectivity. It's the composability of asset that today does not happen at scale, meaning I cannot easily deliver equities into a clearinghouse. I cannot deliver equities to lend to different lenders to lend money to me against my equity. Those type of products today do not exist. I cannot take a private credit fund that I own that pays me actually really good cash flows and go to a lender and say, here, I'll pledge that private credit fund. Can you give me a loan against that? I actually think that that is the much more exciting opportunity around tokenization, is asset composability and embedded products that today we can't even imagine. So to me, that's the more exciting part about tokenization.
Okay, gentlemen, 30 minutes is not enough. Thank you.